Markets are kicking off the week with cautious optimism as investors weigh local policy signals and global uncertainty. Here at home, the BSP's signal of possible rate cuts and talk of a shift to a fixed 2% inflation target could spark renewed interest in Philippine assets. Overseas, President Trump's delayed 50% tariff on EU imports has calmed markets for now, even as fresh threats against tech giants keep investors on edge. Meanwhile, the Marcos administration's ongoing cabinet shakeup is being closely watched for signs of policy continuity and economic stability. Joining us now to break it all down is BDO's Chief Investment Officer, Fritz Ocampo. Fritz, so good to have you with us.
Thank you for having me, Mikey.
Yeah, we've got a lot to unpack, but let's start with the bigger picture. Because, we want to see how things look from your lenses. The BSP says our economy is gaining traction. The ASEAN Plus 3 Macroeconomic Research Office, or AMRO, says that they expect faster growth in the second quarter. Are you seeing this kind of momentum in corporate earnings, in consumer spending? What's your take on this, Fritz?
We agree with the view simply because we're expecting inflation to continue to ease. And with easing inflation, the BSP has already announced that they're open to 2 more interest rate cuts of 25 basis points each. And lower inflation and lower interest rates will allow consumer demand to accelerate and your local investors to continue to accelerate capex in the second half of this year.
That said, you think the second half is going to look much better than the first half because we've got that mix of lower interest rates, lower inflation, inflation well within expectations. And of course, during the second half, that's when spending picks up. That's when money for tuition comes in and the holiday spending kicks in. So do you think GDP in the first quarter was the lowest that it will be for 2025?
Definitely. The macro environment is more conducive to the second half expansion. We're expecting relative improvement from the first quarter number that we saw. Having said that, the forecasted GDP growth for the Philippines would still be on the lower end of the government's 6 to 8% target for the year.
Specifically for Q2 GDP from 5.4% in Q1, where do you forecast Q2 GDP to come in? Still sub 6?
With the election spending that has been built in and lower inflation and the rate cut that was implemented in April, we're expecting somewhere between 5.6 to 5.8% GDP growth in
to
2Q.
5.8. Okay. What about for the full year of 2025?
For the full year, it would still be sub 6%. Right now, where BDO is forecasting 5.9% for full year 2025.
Okay, what was that again?
5.9%.
5.9%. Okay, still slightly below the government's 6 to 8% target range. So you don't think the government's target range is achievable at 6 to 8%?
Well, it would be more on the lower end of the government's target. But having said that, when you compare whether you're looking at 5.8 or 6%, relative to our ASEAN neighbors, the Philippines will still end 2025 as one of the fastest growing economies in the Asia-Pacific region.
Yeah, if not for the stresses, the tariff stresses, we could be on a much better footing. Okay, Fritz, we're now in the middle of a cabinet reorganization. But the economic cluster has been retained, which signals, continuity and some stability in the midst of all of this flux. From a market perspective, how does this mix of continuity and change bode for the markets?
The fact that the president extended the whole economic team right away was seen positively by the market because it will minimize the uncertainty from the business sector, from the private sector community. And this is essential given the fact that we're playing catch-up to attain the government's growth targets for this year. So we don't have any time to lose. And that was a good move by Malacanang.
Yeah, everybody's happy to see them wholly retained. Taking a look at where we are in terms of numbers, the BSP rate cuts, with inflation at a 5-year low, BSP Governor Eli Remolona has signaled the strong possibility of 2 more rate cuts this second half. What's your take on the timing and the likelihood of these cuts?
We believe that the rate cuts should be front-loaded. And the fact that the BSP cut in April, we believe that the June 19, 25 basis point cut is a done deal.
Okay.
Given the latest inflation numbers, given the fact that the economy is slowing down, this is the time to move ahead with another 25 basis point rate cut.
So you expect 2 more rate cuts of 25 basis points, bringing the total rate cut for 2025 to 75 basis points. Okay. And what kind of a market does this make for us?
With the peso appreciating now by 4% and 75 basis point rate cuts, that allows, number one, our bond market to rally as we move towards the second half of this year, number one. Number two, on the equity side, this allows foreign fund managers to now seriously consider the Philippines as an alternative market, given the fact that we are least hit with the tariffs, number one. Number two, that we are not a major exporter to the United States. And number three, with the lower inflation and lower interest rates, it allows margins to continue to improve and earnings growth to continue to grow by 9 to 10% in 2025.
Speaking of inflation, we are at a 5-year low. What are your expectations for inflation for the full year 2025?
Our forecast this year is 2% from the 3.2 of last year and the 6% of 2023.
Okay.
So that's a solid improvement. And given the fact that the forecast on global rice prices and oil prices favors the Philippines' outlook on inflation, we believe that our forecast would prove to be the right direction as we end the year.
Speaking of that solid 2% and direction, you know, the BSP is thinking of setting a fixed 2% inflation target instead of the current band, which is 2 to 4%. What do you think are the strategic implementations of having this exact figure as opposed to that band, that 2 to 4% band?
Giving an exact number gives more clarity to the market on where the monetary board wants the inflation trend to move towards. The fact that they are now considering a specific number, say 2%, this is in line with what developed markets are already doing, like the United States and the EU. And you know, it would allow the business community to really plan for the long end, for the long term.
So you're in favor of this shift
I
to
think
the 2%
it's a
target?
good move. It's a good move by the BSP.
Okay, great. You know, another thing, on another front, I wanted to ask you about this. The U.S. recently lost its last AAA credit rating. I mean, it was symbolic because they had lost it in the past, and this was just, you know, it's just sealing the deal. Are you worried that the U.S. has an unbridled fiscal deficit, as these credit rating agencies are worried, obviously?
The latest downgrade was quite delayed since the two other credit rating agencies had moved ahead of them already. And it just cements the view that the credit rating agencies are worried with the growing fiscal deficit funded by more borrowings by the U.S. government. And the implication here is that we could see higher for longer interest rates in the U.S., which would eventually
What does that mean for us, right? All those worries, they're worried about the U.S., paano na tayo?
Which would eventually move to the Philippine market, since our Philippine market tracks the U.S. Indicators such as interest rates, exchange rate, even the stock market. And so higher for longer might be a concern moving forward. And that would mean that the business community would have to take in these costs in the long end.
How do you think that's going to bode for the peso? With the credit risks in the U.S. re-emerging, where do you see the peso-dollar pair heading?
So the peso appreciation recently, now up 4%
year to date,
is really a reflection of the global community's concern on the U.S. economy. The strong dollar view that we've seen over the past 7 years, we believe has come to an end. With high tariffs leading to high inflation and a slower growth clip for the U.S. economy moving forward, and concerns that the U.S. could be heading for recession, that is what the dollar weakness is reflecting, is pricing in.
Are you pricing in that the U.S. will go into a recession? And if so, what kind of a recession are you factoring in?
The U.S. could be headed for a mild recession. By mild, we mean less than 1%.
Less than 1%.
No? The contraction that we saw in the first quarter already reflected the front loading on the importer side. And in the next 2 months, the U.S. economy will really see the price of goods moving up as the inventories will run out.
Yeah.
And they will have to start importing once again at a higher price.
Yeah, well, our exporters are worried too. I mean, we just had the story earlier about exporters raising concerns about the double whammy, the strength in the peso and the renewed tariffs from the U.S. From your perspective, how big of a drag is this on our export sector, and how might that affect earnings, jobs, and even our broader GDP?
It would definitely be a concern for our exporters. What would be positive for the importers will be a negative for the exporters. But let's not forget that the peso depreciated by 15% over the last 5 years. And during that period, we didn't see any acceleration in our export market, nor in the volume of export goods. So it will remain a challenge moving forward if the Trump administration doesn't tone down the rhetoric on tariffs, if it will be here for the remainder of the year and the remainder of his 4-year term, then it would really be a challenge, not only for Philippine exporters, but globally for exporters to the U.S. market.
And Fritz, how do people make money in this kind of macroeconomic environment? We've got so many shifts overseas and locally. If you had 100,000 pesos in free cash flow, where would you deploy that right now?
That's an excellent question, Mikey. And the answer there is to have a, number one, diversified portfolio. And number two, try to reduce your risk. What do we mean by this? Diversified portfolio. If before you were just focused on peso fixed income, you have to diversify it in favor of other assets, like REITs, like equities, whether it's global or local or global equities. Number one. Number two, reduce the risk. If before you were buying 20-year notes or 10-year notes, try to reduce the risk, because the long end will be moving up. It has already moved up and it will continue to move up. That's a reflection of the concern on higher inflation. So you move down towards, let's say, the 3 to 5 or 3 to 7 year part of the yield curve, and you'll be able to reduce your risk. If before you were like 80% exposed on global tech, this environment
is not conducive to that anymore.
Not conducive to tech. When interest rates move up, that's a negative for the tech sector.
Okay.
So try to reduce your tech as well. If before you were just focused on the U.S. market because of the, the rally, the bull market that they experienced, now you try to diversify in favor of Europe and try to reduce U.S.
Okay. Now, Fritz, we're on cable, we're on free TV, and we're online. If you want the people watching to take one thing, to learn one thing from you, from this interview, what would that be? What would you like to impart on our viewers?
Number one, this high interest rate scenario is an opportunity to lock in those yields, let's say in a 5-year bond or in a 7-year bond, and get coupons regularly. Number one. Number two, the volatility in the equity market, the fact that the Philippines is now trading at 9.6 times forward PE, is a mega sale in the SM parlance. Okay? So take advantage of this opportunity. So the only advice, if I may give
is to buy low,
is to invest.
Yeah.
Don't be scared and just put your money inside your drawer.
Yeah.
It doesn't work. Take advantage of these periods of volatility to buy on the dip.
Yeah.
When you go shopping when there's a mega sale, right?
Yeah.
And this is a mega sale.
This is that mega sale. All right. Thank you so much, Fritz Ocampo, Chief Investment Officer of BDO. Good to have you with us.
Thank you for having me.